Bloomberg Audio Studios.
Podcasts, radio, news.
Nvidia, one name making up a little more than 4% of the index and almost 100% of the enthusiasm to buy stocks in the last 24 hours. That single name adding $276.65 billion in market cap in a single day. A single day. That's a new record. The old record belonged to Meta, and that was only 3 weeks old. The move wasn't just isolated to just one stock, one sector, or even one country. It was enough to help push equity markets worldwide to record highs. Stateside, the S&P, all-time high. The Nasdaq 100, all-time high. In Europe, the Stock 600, all-time highs. Germany's DAX, all-time high. Even in Japan, we reclaimed a milestone going back to 1989, the Nikkei 225 at all-time highs. This is happening with negative GDP in the UK, negative GDP in Germany, negative GDP in Japan, and interest rates in America at multi-decade highs. The stock market is evidently not the economy, and high interest rates have done little to dampen the enthusiasm to buy equities. Some are confused. Marco Kolanovic at JP Morgan saying we find current market developments odd. Others are nothing but jubilant. Dan Ives of Wedbush says this is a game-changing moment for the tech bulls and puts jet fuel in the tech bull market thesis as the derivatives of AI play out over the coming 12 to 18 months. To discuss a week full of records, I'm pleased to say we're joined by a good friend of this program, Mohamed A ElErian. Mohamed, what a week it's been. I just want your early response, your initial reaction to the price action yesterday off the back of earnings on one single name.
I think, John, is totally understandable. I think there is a revolution going on in AI fed by four things that will only grow in importance, and that is computing power, data, talent, and financing. There's a very long runway, both on the supply side and on the demand side for this sector. On the supply side, we're going to see capabilities improving, expanding. On the demand side, it's not just about AI add-ons that a lot of companies are talking about today and trying to do. It is about developing things that are AI native. So when I look at this, I totally understand the excitement about the sector, and I totally understand how that sector can suck investment into many other things. So it doesn't surprise me. This is a secular story, John. Now, will there be excesses in parts of the market? Of course there will be. But there is something real going on that can enhance productivity and have a huge impact secularly.
You called it a secular story. Can we talk about the cyclical impact? Mohamed, we were talking to Jens Nordvig of Exante Data, and he was making the connection between what would happen to growth in America, to productivity in America, and how the Federal Reserve might have to reconsider how high rates might have to be in the years to come. Are you making that connection yet?
In years to come, yes, John, but this is not a Fed that has been basing policy on years to come. This is a Fed that's been basing policies on past data. It's been overly data dependent. But he's right in the sense that when working out productivity and growth potential, you've got to factor that in. It is a transformational, and it's not the only one, John. You know, you've been hearing me say there's three of them. There's what's happening to generative AI. There's what's happening to life sciences, and there's what's happening to green energy. And you've talked to my colleague, Michael Spence, on these issues, and you know how strongly he feels as well.
Spence was fantastic. I want to talk about the recent Fed communication we've had as well, Mohamed. Governor Waller, what's the rush? Do you share that opinion? What is the rush?
Do you remember when you repeated what I said a few months ago? When you asked me what's going to happen, I told you let me tell you what should happen and let me tell you what will happen. And I said at that time, 3 cuts starting in June. And that was at a time when the market was seeing 6 to 7 cuts starting in March. So we are now in a really good spot. We are now at a point where the market has finally converged to what the Fed has signaled. And it's really important to try and maintain that alignment because there's so much else going on. So I think it is right to say patience, but that communication shouldn't go too far. What's going to be hard, John, is to stick to the 3 cuts, both by the market and by the Fed, at a time when the inflation data is going to get much more bumpy.
Mohamed, what surprised me? I'll tell you what didn't surprise me. That spread closing had to close. I'll tell you something else that didn't surprise me, how that spread closed. I was with you. The market coming towards the Federal Reserve. It's what didn't happen as that spread closed that shocked me. We've priced out all those cuts we had priced in since the end of October. We've pushed out the timing. We've reduced the magnitude of interest rate cuts this year. And yet still, this equity market's carried on rallying. The two-year yield's up 50 basis points in just something like 3 weeks and change. And Mohamed, still, this equity market carried on rallying. And if you'd asked me at the time, whatever my view's worth, back then, if we were going to close that gap in that fashion, if two-year yields were going to reprice higher by, let's say, 50 basis points in 3 weeks, I would have said stocks down hard. Stocks are up. How do you explain that, Mohamed? How important is monetary policy to equity market pricing, given the dynamics in Nvidia, in AI, in big tech?
You know, John, simply put, it's one of three factors. Interest rate risk, of course, has been a significant headwind, but you've had two very strong tailwinds. One we just talked about, which is a secular journey that we've embarked on, led by these incredible innovations. And then the second significant tailwind is the strength of the economy. You know, we were also surprised by a 3.3% growth rate in the fourth quarter. We were also surprised by an almost 5% growth rate in the third quarter. And the U.S. locomotive has been strong enough to offset the numbers you showed in terms of recessions in Germany, UK, and Japan.
Do you think that should lift all boats abroad, though? And you mentioned the recessions in the UK, Germany and Japan. We've also got all-time highs in Germany and Japan. Mohamed, can you explain that just by the US alone?
Well, what you can explain it by is people looking at valuations differentials and seeing that other markets look incredibly cheap relative to the US and wanting to go fishing there as well. You know, a lot of people have been saying, well, if I'm going to invest at the US at these levels, just look at how much cheaper other markets are. So you're getting massive spillovers because people are looking at relativities, John.
Do you think those easing financial conditions should be of concern to certain central banks still grappling and lacking confidence of getting inflation back down towards target?
So you're taking me to the question that you know I don't really like discussing, which is what is the appropriate target? We're living in a world where, given everything that's going on the supply side, we're talking about geopolitics, we're talking about companies rewiring their supply chains, we're talking about what's happening in the labor market, that when you look at all this, if I was a central banker, I would be aiming at an actually long journey back to 2%. I wouldn't rush to get back to 2%, because in the back of my mind, I would believe, as I believe right now, that if I was to set an inflation target today, it would be higher than 2%. It would be closer to 3%. But of course, I can't change that because I've missed my target for so long. So I in the back of my mind, I would not be in a rush to force it back to 2%. And that's really important. If that is my mindset, then I can live with these financial conditions. If my mindset is I need to get to 2% really quickly and that's the right inflation target, then I would be concerned about financial conditions.
Well, Mohamed, we also have to acknowledge why you said that all that time ago. The reason you said that is because you believed initially that in order to get back to 2% and over, say, 18 months, 2 years, we needed to crush the economy to do that. The lesson of last year was that maybe we don't, perhaps. What's the question now that you'd be asking with regards to that? Do you think we can achieve that inflation target without crushing the service side of the economy, given the disinflationary trends that have emerged over the previous 6 months?
So let me give you my probabilities. I think it's about 55% probability that we can get towards a stable inflation rate that's low enough. It won't be 2%, but that's low enough and that's stable enough that it anchors inflation expectations without crushing the economy. I'll give that a 55%. I'd give a 30% probability that either because of an external shock, and there's a lot going on in the world right now, or a domestic political change, or a policy mistake from the Fed of staying too tight for too long, 15% that will slip into a mild recession. 30% will slip into a mild recession. And 15% is that the productivity gains that will occur over a number of years happen much more quickly. And then we find out that we get to what some people call the no landing, that growth stays incredibly robust while inflation stays well behaved.
Mohamed, Governor Waller yesterday was talking about they want to see a couple of months of inflation data to make sure that they're prepared for these cuts. You're looking at June. What needs to happen in terms of goods disinflation between now and June for you to be comfortable?
No, I'm comfortable now, okay? And I'm comfortable now because I look way beyond. I think that data dependency doesn't mean data obsession. It's very, very, very problematic if you get obsessed by data, because you need to look forward. Your measures act with a lag, as you know, Anne-Marie. So if you are totally basing policies on the last few months of data, you will get it wrong. And that is why we have had such a reactive Fed. That is why communication has been such a problem. So I don't need to see 2 more months of data to feel comfortable cutting 3 times starting in June because of what I see ahead. But if this Fed remains obsessed with being data dependent and seemingly solely data dependent, that they want to see goods inflation staying well tamed while service inflation coming down. That's what they need to see.
Mohamed, let's just finish this segment by asking a simple question. I know it's difficult to answer, but what evidence is there that they are sufficiently restrictive, looking across the economic data we've had, not over the last month, but over the last 12?
So borrowing costs have gone up. True spreads haven't gone up like everybody expected, but that has to do with the fact that credit risk has been supported by economic growth. Inflation has come down, and it's not just a supply side issue. We've seen major adjustment in interest rate sensitive sectors. So there is evidence that they've had an impact through higher rates. John, my concern honestly is that now the market and the Fed, surprised by the fact that the inflation numbers are getting more bumpy, will end up being too tight for too long.
Okay, let's just go there again. Let me ask that question, Mohamed. You think the biggest risk here is that they hold too long, not cut too soon?
Correct. If they don't cut in June, then you'll hear me say, oh no, we're now making the opposite policy mistake that we made back in 2021.
Interesting. This conversation, Mohamed, is going to continue. It's fantastic to have you with us. Mohamed A ElErian, you know what the elephant in the room is here? It's the $300 billion in Russian central bank reserves that were effectively frozen back in 2022. What are we going to do with them?
It's a great question. These reserves, some people are saying potentially if there's going to be an opening to have a peace negotiation, does the U.S. use this as a carrot and stick approach? This is something that everyone says amongst all the sanctions that's been levied on Putin, this is the one that hurts the most.
Mohamed A ElErian still with us. Mohamed, we don't have to talk about this directly, but more broadly, the world becoming a more fragmented place. You and I have been talking about nearshoring, friendshoring, deglobalization over the last few years. When you look at those themes, Mohamed, does that still contribute to your idea that this is going to be a regime post-pandemic that has higher inflation, more volatility than the one we had before the pandemic?
Yes, absolutely, because you have 2 distinct factors. You have first the non-commercial determination of supply chains for geopolitical reasons. And then you have a second factor that's coming in as well that tends to aggravate all that, which is the continued weaponization of economic and investment tools for the purposes of national security, which is totally understandable. But both these tend to be inflationary. John, I think the biggest surprise, including for me, is that the Russian economy did not suffer as much as most of us expected. Did not suffer in terms of the contraction. There were projections of 10 to 15% when Russia was thrown out of SWIFT, when the sanctions were put on. And the IMF in its latest projections increased growth for this year in Russia to over 2%. And that tells you 2 things. One, that with hindsight, the West should have been much harder on the sanctions, fewer exceptions, and taken the risk of collateral damage that you just heard Michael talk about. Because the second issue that does is it signals to the rest of the world that maybe you can live outside the Western system. Well, that is not as much as a threat as most of us thought it was.
Well, we were talking earlier with Peter Cheer about the fact that Russia just created new markets. India and China is where they now sell all their energy, and Europe at one point was one of their biggest partners. So in that sense, Mohamed, have sanctions actually worked?
So not only have they created new markets, Anne-Marie, that created new payment systems that bypass the dollar completely. And that is, I think, what has surprised many, including me. The Russian technocrats working with others have come up with this very clunky system, but nevertheless allows for international payments without going through the core of the system, which is this image of little pipes being built around the core. And the worry is that you're going to encourage more people to build these little pipes. So that's the fragmentation of the economy. Look, there was a decision to be made early on about how hard are you on energy? Should you threaten secondary sanctions or not? And for the reasons that Michael pointed out, the decision was don't go that far. And therefore, sanctions are as effective as the sanctions you employ. And there were two major loopholes left in round one.
It's hard to know the answer to the following question with any certainty, but let's just explore it anyway, Mohamed. The elephant in the room. If they confiscate those Russian central bank reserves that were frozen 2 years ago, how concerned would you be that other countries would begin to ditch Western currencies?
I think other countries would look at that very carefully. Look, John, in economics, there's always this notion that says, make sure that you have enough tools to meet the number of objectives you have. And we are pursuing sanctions for three objectives. One is to punish Russia. Two is not to excessively harm the global economy. And three is not to excessively harm the role of the dollar in the global system. And you cannot get these three objectives with just a single tool of sanctions. And that's why you hear, sanctions are not enough. But the risk is that you end up trying to pursue all three using a single sanction, and then you end up with not satisfying any of the three.
Hey, Mohamed, this was great. Just awesome to catch up with you. Good friend of this program, good friend of mine, Mohamed A ElErian of Bloomberg Opinion.